All right. Well, welcome to this week's P&L review. We are going to do a P&L review on a real estate team that is not healthy, and I want you to see what it is we're looking at to determine that. And so um, let's jump right into it. I'm going to share my screen here. So here we go. As I always tell people, there are two lenses in which we could look at your P&L. One is through the lens of the IRS, and the other is through the lens of a CEO or a CFO or an entrepreneur, a business person. And there's two different reasons we view the P&L. One is for tax purposes, the IRS and their CPA's view. But the other one, and frankly, the more important reason I think, is for making better business decisions around, to making sure we're running a truly profitable business. And this is where I see most real estate team leaders get confused. So today I'm going to show you how to look through both lenses. The first lens is going to be through the lens of the IRS. So let's look through that. For example, total income. Let's start with that category. $225,000 of total income for this team, January through March of this year. The second section of our P&L is our cost of goods sold then. How much got paid out to agents, brokers, the broker, the agents, and referrals. Okay, in this case, $139,000 or about 62%. That left us then with our gross profit of about $86,000 or 38%. That's just the remaining piece, right? If we had 225 to start with, we paid out 139, we were left with 86. 100% of the pie is now eaten up. Now, from that orange line, our gross profit, we had to pay the bills. And so let's look at where the money went in terms of operating expenses. So in this case, we have three sections of operating expenses. The first section is our lead gen marketing. That's everything in that section there. Total lead generation and marketing costs for this team during this period of time was $17,000 or about 7.5% of the revenue going towards that. Then we have our people expenses as the second category. Total people expenses was $25,000 or about 11%. And then we have our overhead as the third category. And that's just everything else that wasn't a lead gen or a people expense. Those are our three main categories. That is 14% of the revenue. So our total expense was $73,000 or about 32.5%. That left us with a net operating income of about $13,000 or almost 6%. So when we look at that, let's break that out. Let's break that out. The IRS view, right? We'll just write that out. The IRS view, like what our numbers on paper said. What it said was we generated $225,000 of total revenue. We paid out $139,000 in cost of sale. We had $86,000 left in gross profit that actually hit our bank account as the business owner. And then we spent $73,000 on operating expenses, and we were then left with $13,000 in net profit. Now, the percentages on those are 62% going out in cost of sale, which left us with the 38% in gross profit, and we spent 33% on operating expenses, which left us with about a 5% net profit margin. So if we look at that from a visual perspective, like a pie, $225,000 in total revenue, 62% up here in cost of sale. We were then left with the 38% in gross profit. So that's those two first sections. Then from that 38%, we had to pay the bills. And we spent 33% on operating expenses, and we were left with that 5% in net profit. That's the model here. So you might look at this and say, oh, we got a 5% net profit on this team. No, we don't. Here's why. This is not the adjusted net profit. This is the profit number based on our P&L, which doesn't always tell the true picture for a couple of reasons. One, how much production the owner did where they paid them 0% themselves, $0, 0% in cost of sale, right? The owner did, in this case, about $37,000 in their own revenue of the $225,000, where they paid 0% in split to them. So on paper, it says we have a 62% cost of sale. It's not accurate. because that includes $37,000 of revenue where there was 0% cost of sale. So we need to adjust for that and look at the business as though we were paid like an agent as the owner. So we're going to adjust for that. The second thing we're going to adjust for is the owner's salary. Why? Because they're paying themselves because they're an S corp and the IRS requires it. So it looks like they made less money than they actually did. So when we adjust for those two things, here's what the actual numbers look like. We're going to call this the adjusted net profit. This is the view of the CEO, not the IRS. The whole purpose of this is to really truly understand the health of the business, not just the tax consequences. Again, up here, the IRS view is all about taxes. On paper, it looks like we made 13K and we're going to pay taxes on that amount. But that doesn't tell us the true health of the business. Let's adjust the numbers. So the adjusted numbers, the same $225,000 of revenue. But if we paid ourselves like an agent, we would have had $166,000 in cost of sale. How do I know that? Well, here, let me show you. I go up here to our bookkeeping. Again, as long as we have good bookkeeping that's done in a real estate specific way, this becomes pretty easy to identify. So all we have to do is look at a couple things. We got to look at how much did we pay out to listing agents and buyer's agents on the listing revenue just from the team and the buyer income just from the team. You can see up here in income, we have two sections. One is this section that is owner income and this section that is team income. It's very important you separate the two in your bookkeeping so that you can see truly how much the team brought in versus the owner. Because again, in most of the cases, the owner's paying themselves 0% split on those deals. And so we need to see the difference. What we can look at here when we calculate that is we say we paid $28,000 out to agents on the listing side of the business, and they generated $35,000 in revenue. So what's that percentage? That is 78% listing cost of sale. So when a team member on our team does a deal, on average, they get 78% in this case. By the way, that's not good. But let's look at the buy side. $91,000 of commissions paid out to agents on $140,000 of income from those agents. That's 65% buyer cost of sale. So now what we do is we take these percentages and we apply them to the owner's income where currently there is 0 cost of sale, and we apply the buyer percentage to the buyer income on the owner and the listing percentage to the listing income on the owner. And what that allows us to do is allow us to see exactly how much we would have paid to an agent had they done these deals versus the owner. In other words, we're accounting for the cost of sale that's currently not there, right? Because we didn't pay any cost of sale on these owner deals. So when we adjust for that, the cost of sale on this $14,000 of buyer income would have been $9,408. And on the listing $23,000, it would have been $18,000, would have been paid out to agents on those deals. So when we add those two up, it comes out to $27,408 would have been paid out on those deals, but weren't. So what we need to do is add that $27,408 to the cost of sale, which changes the amount we would have paid out. Instead of on paper paying out $139,000, we would have paid out $166,000, which means we wouldn't have kept $86,000. We would have only kept $59,000. So if we go back into our adjusted net, we would have paid out $166 in cost of sale versus $139. So that new percentage would have been 74%, which means we would have only kept $59,000 in gross profit, which would have been the remaining 26%. The expenses, instead of being $73,000, let's go up and look at how much the owner paid themselves in salary. They paid themselves $15,000. So we need to take 73 minus 15, which is 58. That would have been their true actual operating expenses, 58,000 in operating expenses, which would have been ironically 26%, which would have left them with about $1,000 in net profit and any owner pay there, which is basically 0 to 1% if we're rounding. So this is the actual numbers of the business model that they're running. When we account for the owner's salary, we adjust for that, and we adjust for the true cost of sale. So literally this team, if that owner stepped out of production, the model that they're building is a 74% cost of sale, the amount that got paid out to the agents, the broker, and any referrals. And then we would have had a 26% gross profit. And then in this case, we would have spent 26% on operating expenses. So we would have had basically 0, or in this case, $1,000 in net profit. This business is making no money. So do you see how on paper it looks like we have at least a 5% net profit, but in reality, we're basically breaking even. So then the issue becomes, well, where do we fix the problem? In my case, they have a huge cost of sale issue. If they're going to spend almost 30% on operating expenses, which I have no problem with, they cannot pay out 74% in cost of sale. It just doesn't work. The math doesn't math, right? And so we would have to clearly address the fact that their cost of sale is as high as it is. And it could be for a number of reasons. It could be their splits. Most likely it is when it's this high. It could be the fact that their agents are doing too many SOI deals because the lead agent's heavy in production and no one's there to hold the agents accountable. It could be, that their broker costs are super high. I don't know. We'd have to look at it. But the point is now we can dig and fix the problem. Either they need to change their cost of sale, or they need to reduce their operating expenses dramatically if they want to make any kind of money. But in this case, they're running a model that does not make money, even though on paper it shows that it does. And that's the importance of accurate bookkeeping and looking at those books through not only the IRS view, thinking about taxes, but also a CEO view, thinking about the health of the business. Hope this was helpful. Thanks for joining, and we'll see you on our next P&L review.